Hi everyone, welcome back to another video from your Tutoring team. It is Whitney again, yes, and I'm back with part 2 for our Principles of Accounts, January 2020, paper 1. Right, and of course, you know the drill. Before we get into it, guys, go ahead, reach out to us via WhatsApp, follow us on Instagram, Tutoring, subscribe to our YouTube channel, and you may email us at withtutoring@gmail.com. Of course, subscribe, like, share. Right, reach out to us. It's not too late. It's never too late until the day of the exam. So even the day before, you need a little brush up, you can always reach out to us and we will assist you as best as we're able to. Right? And trust me, our best is, oh, magnificent. All right, without further ado, let's get into the paper. So we're picking up at number 16. So this says, which of the following entries would not appear in a cash book? Remember, our cash book shows what receipts and payments, right? Pay attention to the keyword will not appear in a cash book. Payment for goods. The cash book shows money coming in, money going out. Payment for goods will be money going out. Goods sold on credit. There's no money taking place there, so that would not go in our cash book. Because on credit means say you trusted something, right? Sell on credit, there was no exchange of money. There was no money that changed hand or whatever. So that would not be on a cash book. Would sold for check, of course. Money coming in. Goods bought for cash. Of course, that's money going out. All right, 17. K kind of debtor of A and B enterprises settles his debt of $120 less discount by check. How should a double entry be recorded in the books of A and B enterprises? All right. So the full debt is $120. Based on the options here, you can see that the discount is $30. So KCAN is a debtor of A and B. Pay attention to the entities. KCAN is a debtor for us. We are A and B enterprise. That's a business. We want to know how it should be recorded in the books of our books, A and B enterprises books. So how do you record payment made by debtor? You have to debit the money you get. His account was, he owed $120, but there was a discount of $30 given. So he would pay us $117. Discount allowed would be $30. And he would credit KCAN of $120 to reduce his account because he's a debtor. Debtors are assets. So to reduce your debtor's account, you have to do a credit entry. The answer here is C. Mr. A. Jones paid $250 in cash for repairs to machinery. This transaction was recorded in the cash book and posted to the ledger. The double entry involved would be, all right, we're paying in cash for some repairs that we did to machinery. So, right, so the repairs, so that's an expense. That's like a revenue expenditure. It's not a capital expenditure. Capital expenditure is like those expenses for like acquisition, maintaining, upgrading of or installation of your like assets, like fixed assets, right? So like you're bought a new motor vehicle, that's capital expenditure. If you're installing you bought an equipment and you have to install it, the fee if you buy it, the fee if you install, that's capital expenditure. But where we have revenue expenditure now, these are just expenditures from the day-to-day operations of the business, right? From operating. These expenditures stem from operating, from operations. Like repairs to your motor vehicle would be a revenue expenditure, right? So you would debit your repairs account as an expense and you would credit the cash account because you're paying in cash. So your money, your cash is getting less. And because cash is an asset, you have to credit your cash account to show that it is decreasing because you credit assets to decrease them. All right. Number 19. In order to avoid writing numerous checks for small amounts, a firm may set up that is a petty cash fund. my darling. That's the purpose of a petty cash fund. So use this petty transactions. So use a petty cash fund to deal with your petty transactions, your small transactions. Item 20 refers to the following information from the sales book of R. Lewis. How would R. Lewis record this information in his ledger? Alright, so you realize that we gave a trade discount to H. Rick. So H. Rick bought 30 items at $1.50 each. It should have cost $45. We'll give a 33.33% trade discount, which comes to $15, which would mean that H. Rick ended up paying $30. Please note that while you record your cash discount in your books, you do not record your trade discount. Like with a more account I call discount allowed, that's a cash discount. Your trade discount, no. So here you would record $30. And you're not gonna make any record of the $15 because it's a trade discount, right? Your answer here would be to debit Atrix account of $30 and credit your sales account. 21. A businessman bought a new computer for $6,000. He paid $4,000 in cash and traded his old computer. What is the entry to record this transaction? All right, new computer costs $6,000. So you go up a debit your computer account, the new computer account with the $6,000, right? It's an asset. And you're trading your old computer, which was worth $4,000. You're getting rid of that old computer, so you have to do a credit entry to show that you're getting rid of the old computer of the $4,000. And the remaining, no, a lie. Sorry, trading would be $2,000, right? Yeah, the trading would be $2,000 for your old computer, and the $4,000 is the cash that he would pay. So the $4,000 would be a credit entry for your cash as well. So you debit your new computer with $6,000, credit the old computer with the $2,000, and you credit cash with $4,000. Remember, debit and credit must always be equal. They must balance out. So you realize this is a compound entry, we call it, guys. So you realize that your two credit entry add up to 6,000. So total credit is 6,000, total debit is 6,000. It should always be balanced, or you do something wrong. When a proprietor withdraws cash or other assets from a business, what effect does it have on drawings or capital? This was in the 2016 paper that we looked at. And bear in mind that, yeah, these questions will tend to repeat, so practice as much paper one as you possibly can. And stop by, get some videos, and make sure you're on the right track with your reasoning and your answers. And of course, if you need further assistance, reach out to us. We're always happy to assist. All right, so here, what effect does drawings have on capital? Drawings decreases your capital. We're supposed to know this by now, all right? All right, item 23 to 25, which is the following statements of financial position. Remember that statements of financial position is another name for your balance sheet. So you have leasehold premises, furniture and fittings, blah, blah, blah. What is the total value of fixed assets? Your fixed assets are those assets that you intend that have an expected life of over a year. You intend to have those for more than a year, and they're not for sale, they're for use within your business, right? So let's calculate your total fixed assets. That would be your leasehold premises of 10,000 plus your furniture and fittings equipment of 4,500. So that's 14,500. You literally have to do nothing. You just need to go up a and pick out the figure right here. So literally. Closing capital is, again, come up here. So you don't need to do a thing. Capital at start is your opening capital of 24,000 here. You minus your loss for the year. And then you subtract your drawings of 1,800. What if you have a left after you do that? Is your closing capital. So this 20,000 right here, so your closing capital. If it was a profit that you made for the year, you would have added your net profits, right? So 20,000 right there is your closing capital. Oops. All right. The working capital is, remember what working capital is? It is your current assets minus your current liabilities. So here are our current assets. Your total current assets is the inventory, receivables, bank account, and cash in hand. Your total current assets is this 8,800. And here are your current liabilities, creditors and accrued expenses. Your total current liabilities come to 3,300. So it'll be total current assets of 8,800 minus your total current liabilities of 3,300, and that should give you 5,500 as your working capital. In calculating the gross profit percentage, let me see if this question is finished. Right, this question goes to 25. So that's finished with that balance sheet. So in calculating the gross profit percentage, gross profit should be divided by, what do you divide your gross profit by to get gross profit percentage? Guys, you're supposed to know your ratios. If you do, all right, here the thing with ratios. Ratios are simple in the sense that there are formulas. So know your formulas for your ratio. Probably only thing I can say guess what? Know your formulas for your ratios, all right? So the answer for this is D, your net sales. So to get your gross profit percentage, you're gonna divide your gross profit by your net sales. Item 27 refers to the following information. This is an insurance account. Insurance is an expense. This is an expense account. What is the amount of insurance prepaid at the end of the year? So based on this, it's an expense account, right? So for your expense account, what we're looking for here, your balance, let's look at your balance carried on here. You realize that your balance carried on is 600. It falls on which side? Your credit side, right? So in that case, the 600 right there on your credit side would be your insurance prepaid at the end of the year. Which of the following financial documents shows the net earnings of a business? Think about it, guys. We're talking about earnings. Net earnings of a business. Which financial statement show your earnings, right? We're used to calculate profit. That's what we're talking about, earnings, you know. So that would be your income statement. Item 29 covers the following table. What is the total provision for doubtful debts? All right, guys, here's what we're gonna do. This is your collectible. These collectible. This is the balance sheet approach for doubtful debts. So for debt of over 3 years, the amount of receivables that we have is 6,000. The percentage that we assume, the provision that we're making, right, that would be uncollectible is 3%. You're gonna find 3% of the 6,000, right? 36 is 18. That's supposed to be like 180. Not sure? Yeah. And then you're going to find the same thing for each of them. So find the 2% of the 4,000. Find the 1% of the 8,000. 2 4s are 8. So 2% of 4,000, and then you're gonna add all of them. The 2% of 4,000 is supposed to give you how much? 80. Right? You're gonna add the 80. So the 180 where you get up at the top plus 1% of 8,000, right? And that's gonna give you an x80. So your total answer, your final answer, when you add all those three, so you add 180 plus 80 plus 80, you're supposed to get 340. All right, so that would be B. So you do each of them, right? So what this is saying, these are based on their age. What do you call this again? Age something. So it was based on, so you have some debts that over 1 year, right? The debt is over 1 year, and you assume that, well, you're providing that 1% of these will be uncollectible. You have the debts then what you have for over 2 years, you're providing that 2%, and you realize that the longer you have the debt is the higher the provision for receivables. the provision for bad debt would be, because the greater the chances that you will be collecting less money. Because the longer somebody owe you, kind of the greater the chance you're really not gonna get back your money, or you're not gonna get back all your money. And 30, an asset purchased for $1,000 is depreciated at a rate of 10% per annum using the reducing balance method. Always focus on the method that you use. What is the book value of the asset at the beginning of the third year? Reducing balance method, guys. So at year one, it's gonna be 10, because remember, reducing balance method, you reduce your depreciation is charged on your net book value. Remember, net book value is your cost minus accumulated depreciation. So in year one, so you're going to take the percentage and you multiply it by your net book value. That's so you use the reducing balance method. So in year one, it's going to be 10% of $10,000. Sorry, of $1,000, right? 10% of 1,000 is how much? 100. That's the depreciation for year one. What is the net book value at the end of year one? After you take out the depreciation from the cost, you're left with how much? So it'd be 1,000 minus 100, which will leave you with 900. And then now, 900 would be the book value, net book value at the end of year one, which would also be the book value at the beginning of year two, right? Because what if you end one year with and start the following year with it? And then for year two, you're depreciating on the 900. That's the current book value. So you're going to multiply the 10% times the 900, you get 90. Then go ahead and subtract that 90 from your 900. You're going to get 810. And that is going to be the book value at the end of year two, which would be the book value at the beginning of year three, because whatever you end a year with, you start the following year with the same amount. So your answer is $810. I think I could play this out for you. So my visual learners, you can see. All right, year one. Let's bring down year one. So cost. I don't know if I have enough space, but let's try. So the cost for year one is $1,000. Remember, depreciation is charged at 10% on your reducing balance method. So remember, depreciation 10%, right? So 10% of 1,000 would be 100. Right? You subtract the depreciation from your cost. You get a book value at year one for how much? Much less, 900, right? And your book value at the end of year one will be the net book value at the beginning of year two. So year two, you start off with a net book value of 900. You charge a depreciation of 10% of that same 900, which should now give you 90. You subtract your depreciation from the book value, and you leave with 810, which is going to be your new book value at the end of year two. Now, that would simply mean that you're going to start year three with that same amount of money, because whatever you end year one with, that's what you're starting year three with. And that is why year three, you have the beginning of the third year, the beginning of year three, you get $810. Okay, that's it. All right, lovelies. So I'll stop here because, as I said, I don't like the long videos. So the next time we will see, we can go from 31 to like 45, or who knows, maybe 60. But I will see you next time. In the meantime, hope you guys have been practicing. Practice. Hope you guys have been studying, and just put in the work. You'll reap the results later. And as always, if you need additional help, reach out to us at your Tutoring team for further assistance. We're always here, happy to assist, happy to guide. And yeah, we're the best at what we do, always. So stay tuned for more videos, more content from your Tutoring team. All right, guys, leave in the chat. We can, sorry, I'm so used to using chat. Leave in the comment section below what you think about the videos, what videos you want, what contents you want more often. And, if you don't understand something, you can go ahead and also indicate that. Or you can also reach out to us via these various platforms. And always, thank you for making it with Tutoring. I'll see you next time. Bye.